The promise was simple on paper: a technology-led payments company connecting merchants and consumers around the world, growing quickly and profitably, and working with third-party partners to reach new markets. The reality, as later reporting and investigations showed, was more complicated. In this episode, we talk through Wirecard as a case study in audits and House of Cards signals. Our aim is practical. We will explain concepts in plain language, point out the kinds of disclosures that deserve a second read, and suggest habits any listener can use when a fast-growing company seems to defy gravity. We will avoid speculation and stick to broadly reported mechanics and lessons. Payments businesses move money for merchants. They sign up stores, process card transactions, charge a fee, and settle the rest back to merchants minus costs. Revenue can come from processing fees, foreign exchange, and services to higher-risk industries. Some payments companies operate directly in a market. Others rely on third-party acquirers or partners in places where they do not have licenses or local presence. This third-party model is not inherently wrong. But when much of the reported profit comes from partners you cannot see clearly, the risk of misunderstanding increases. One of the central themes in Wirecard coverage was the role of third-party partners said to operate in regions where the company lacked its own licenses. In accounting terms, profits were attributed to relationships with these partners, who supposedly processed transactions and paid over a share. If a business model leans heavily on partners, disclosures should help you understand who these partners are in substance, what controls exist, and how cash moves from them to the group. If partners are unnamed, if descriptions are vague, or if cash collections from partners lag reported revenue, those gaps deserve attention. Audits exist to provide reasonable assurance that numbers are free of material misstatement. Auditors test revenue recognition, confirm balances with banks and customers, and probe unusual transactions. In fast-growing, complex groups, auditors focus on key areas such as revenue cutoff, related parties, and cash confirmations. Readers can learn from what auditors flag. In many audit reports, a section called Key Audit Matters explains the most judgmental or risky areas. If the audit highlights revenue related to difficult-to-verify partners or emphasizes the challenge of confirming cash balances with third parties, you are being shown where to be cautious as a reader. Cash confirmations are a core audit step. An auditor does not simply accept a screenshot of a bank balance provided by management. They write directly to the bank and ask the bank to confirm balances independently. When cash is held by a third party rather than an ordinary bank, such as a trustee, an escrow agent, or a payment partner, the confirmation step must still be robust. If a company tells you that significant cash is held off balance sheet or with external trustees, it is fair to ask how those balances are verified and who has authority to move funds. Another theme is the distinction between profit and cash. Healthy businesses cannot manufacture cash for long without real activity. When reported profit rises, but operating cash flow does not keep up over several periods, there is a story to understand. That story can be working capital, aggressive growth with delayed settlements, or something else. As a cautious reader, match profit to cash over a rolling 3 to 5 year window. If the gap is chronic, read the notes that explain receivables, payables, and contract assets to see where the timing difference sits. Complex structures are not always a red flag, but complexity often hides weak links. Subsidiaries in multiple jurisdictions, rapid acquisitions, and opaque arrangements with affiliates can be used to move profit to places where it is easier to report strong margins. If you are reading a set of accounts and see that the majority of the profit is generated outside the core licensed entities, and if the description of those profit sources lacks specificity, slow down. Ask yourself whether you could explain to another person how the company makes money in 3 sentences without nomming internal labels or vague partners. If not, you are relying on trust rather than understanding. Public discourse around Wirecard also described pressure on critics and reporters. As a general rule for your own analysis, recognize that good reporting and thoughtful short theses can be part of a healthy market. Do not assume negativity is malice. Read the details. When a critic points to specific numbers, significant customers that cannot be substantiated, or bank balances that are difficult to confirm, test those claims against the disclosures. If management responds with clear evidence and reconciliations, confidence grows. If responses center on legal posture without new facts, stay curious and cautious. Now, let us convert these ideas into a story of how an everyday reader might spot a house of cards signal. Imagine you are reading an annual report. The company says that most of its profit comes from regions where it operates through partners. The partners are not named, but they are described as leading providers. Cash and cash equivalents are large, but a meaningful portion is held in accounts controlled by trustees rather than in the company's own bank accounts. The auditor's key matters include the challenge of auditing these balances and the recognition of revenue from partner arrangements. Meanwhile, cash from operations lags profit again this year. None of these facts prove wrongdoing on their own. Together, they suggest that you should ask questions and limit exposure until the mechanics are clearer. For anyone who invests indirectly through funds, the same habits still apply. Read your fund's commentary. Ask how the manager evaluates revenue quality in complex groups. Ask what weight is given to cash conversion, to third-party confirmations, and to independent counterparty checks. A strong process does not eliminate risk, but it reduces the chance of being surprised by numbers that look perfect until they do not. If a fund describes a company as misunderstood and undervalued despite persistent questions about cash and partners, ask for the specific evidence that reassures them. If you work at a company that uses payment processors, there are practical steps you can take when evaluating a provider. Ask where your funds are held before settlement. Ask whether the provider uses sub-processors or third parties and in which countries. Ask whether settlement accounts are in your company's name or in pooled accounts. Confirm whether your auditor can receive independent confirmations of balances that belong to you. The safer the structure, the more straightforward the answers will be. If answers are vague or rely on proprietary secrecy, consider the risk of delayed access to your own cash in a crisis. From a governance perspective, boards benefit from independent voices who are comfortable asking simple questions. Where does the cash sit? Who controls it? Which customers generate the highest margin revenue, and how are those customers verified? What specific steps do auditors take to confirm balances that are not held with standard banks? How quickly can the group produce direct confirmations if needed? These are not hostile questions. They are the basics of stewardship. They are especially important when strategy depends on growth in places where transparency is harder to achieve. There's also a personal habit that protects you even if you never read a set of accounts. When a story looks perfect and the results always trend up and to the right, pause and look for the messiness that exists in real businesses. Real businesses lose clients sometimes. Real businesses have outages and reversals. Real businesses describe risks plainly. If a company uses mostly superlatives, if bad news rarely appears, or if every explanation points to one of a handful of unnamed partners being late, that is a narrative problem. You do not need to be an accountant to feel when a story has no rough edges. You should also address the role of regulators and exchanges. Oversight improves when red flags are treated as a reason to tighten systems rather than to punish messengers. Independent reviews of cash confirmations, deeper rules for disclosing third-party dependencies, and faster pathways for auditors to escalate concerns to regulators are all healthy. As a reader, you cannot change the system alone, but you can reward clarity by preferring companies and funds that explain their mechanics plainly. The takeaways from this episode are simple. Separate revenue stories from cash reality. Learn from what auditors highlight as hard to test. Map where profit is truly earned and how it is collected in cash. Be cautious when third-party partners and trustees sit between a company and its supposed cash. Reduce exposure to numbers you cannot explain in your own words. Celebrate the companies that answer simple questions quickly and with specifics. They still make mistakes, but they leave clear trails you can follow. Next time, we move from the structures of payments to the spectacle of logistics and promises. We will look at Fire Festival as a case study in how marketing can outrun operations, and what checklists can keep creators and consumers safer when an event story is bigger than the plan behind it. Narration generated with AI. Facts verified from public sources. No legal advice is given in this episode. The purpose is education and public safety. If you have a case tip or a documented pattern to share, use a safe channel and remove personal information that could identify non-public individuals.